Hello, I'm Hickey from interest.co.nz and welcome to a special report on monetary policy after yesterday's momentous announcement from Labour that it's abandoning 20 years of political consensus on New Zealand's Reserve Bank Act. For 20 years, our Reserve Bank has used the official cash rate, or a version of it, to focus completely on controlling inflation. And the problem, according to some exporters, is that this has meant we've had high interest rates and that's pushed up our currency and made exporting very difficult. Now Phil Goff has come out and said, let's change it. Let's find some other tools or other ways to manage monetary policy so it doesn't hurt exporters. He's calling for a big debate, really. He hasn't suggested any solutions yet, and it was disappointing to see John Key jump on him from a height and say yesterday there would be no debate and suggested that Labour was only interested in increasing taxes. But let's have a look at what New Zealand could do to give us extra tools, different ways of running monetary policy. Firstly, the Reserve Bank has already moved to give itself another little tool on the side called the core funding ratio. This came out of a prudential liquidity review at the beginning of this year, and it essentially forces our banks to be careful about how much money they borrow from the rest of the world, particularly from these hot wholesale money markets. It's forcing the banks to borrow more from local depositors and at longer terms. So it means mainly that the banks are less exposed to violent changes on wholesale money markets. But also it means that the Reserve Bank is giving itself an automatic stabiliser so that when there is cheap money coming in from offshore, we don't get such a rush of it coming in and pushing up the property market like we saw through 2004, 5 and 6. So there was already a bit of a secondary tool the Reserve Bank can use. But there are others that they've actually looked at over the last couple of years and decided not to use. Firstly, capital adequacy. This is where the Reserve Bank forces banks to put aside a certain amount of capital against any lending they do. And the Reserve Bank, in theory, could tweak that number to get banks to increase or slow down their lending into certain sectors, let's say property or farming. Then we have loan-to-value ratios. This is something the Australian Reserve Bank said yesterday they were having a look at. This is where the Reserve Bank forces the banks to say you can't lend more than 80% or 70% of the value of a home. And then there's the idea of a variable GST that Don Brash suggested. This is where the Reserve Bank changes the GST rate to slow down the economy or speed it up. And there's also the idea of a mortgage interest rate levy. This is where the Reserve Bank changes the levy to make interest rates for retail borrowers more expensive or cheaper. Then there's the idea of perhaps having a couple of targets for monetary policy, not just the 1 to 3% for inflation. Should we be targeting GDP, for example, or unemployment? Or maybe we should go for a full managed currency. This is where the Reserve Bank targets the exchange rate, or maybe the TWY rate, instead of targeting the official cash rate. Now, there are others who do this. Obviously, many countries don't have floating exchange rates at all. Some have floating exchange rates where they manage it within a band. Singapore has been one area that some have suggested we should look at. But I think there's a few issues with the Singaporean style. Firstly, they have a lot of savings and a lot of foreign reserves to use as ammunition when they need to move the currency. And also trade is much less dominant here in New Zealand than it is in Singapore. Singapore is a big port and hub. A lot of imports come in and are re-exported, and imports and exports in total work out at more than twice their GDP, which in New Zealand is not the case. Really, New Zealand needs to look at structural reforms that actually change the way we do things within the economy, how much we save, where we put those savings, these sorts of things. I don't think there is a tweak or another little tool or a rewrite of an act which will change this fundamental problem. I think Phil Goff has done a good thing by raising the idea of a debate on monetary policy. I think, though, he should use it as an opportunity to create a grand coalition between National and Labour, where it says we actually need to restructure our tax system, the way we run government, and refocus investment from property to exporting. That requires a flatter, broader tax system, which includes things like a tax on land, maybe a capital gains tax, maybe a higher GST. And there may be an opportunity for Labour to say, in the interests of the nation, we've decided to agree to a broader, flatter tax system which taxes the rich who own property but also increases GST, which would hurt those on lower incomes. How about it? A grand coalition, a bipartisan political consensus on monetary policy that reforms our economy at the same time. Go for your life. I'm Hickey. That was a special report on monetary policy.